right, good afternoon, everybody. This is Event Trader here, being joined by Brett Manning. Brett, you with us?
Howdy.
How's your day treating you so far?
Pretty good.
Yeah, interesting start to the week for sure. Continuing a lot of the action that we're seeing late in the week. And, taking a look at the sentiment readings as one would expect, we are definitely seeing a little bit more caution out there, but certainly not any sort of extreme reading. And the early action from the selling from the last really couple of sessions, Brett, I would say has been pretty calm.
It's interesting to try to disentangle that. I'm not sure whether it is calm, but I assume that you're suggesting that based on the put call readings. Is that
Put call
correct?
readings, I know we've had a 75% jump in the VIX, but it's still well below the 30 level. I know we're getting up towards those May areas, but haven't seen any big bars down on the puke. I suppose you could count last night with the opening, but I'm sure that was a lot of it during right when the Asian markets opened. We're playing a little bit of catch up. We definitely had that break on the headline from from Trump on the tariffs. That would have been midday, of course, on Thursday. But I haven't seen any of that just fall out of bed variety selling. I guess, do you consider today's action pretty panicky, or?
I'm trying to figure that out. So what I do see is that if you look at the VIX futures curve, the VIX is now pretty sharply backwardated from the 1 to 3 month time frame.
Right.
The 1 to 3 month ratio is at 1.07 now. That puts it at the most since we've seen, or since December when we had that complete panic. So more so than it ever got in May and early June, and that's an indicator that does suggest a panicky market. When you see the very near term VIX readings well above the VIX readings along the futures curve, 3-4 months out. So that's definitely
What
happening.
what I
But we're
was seeing
not
on
seeing
the
it as a
VIX
put call.
what I was seeing on the VIX term structure was basically usually bottoms get reached when we hit 1 or 1.2 in times.
Yep,
So
right.
we are
We're
above
about
that.
yeah, we are right. We're getting into that well into that territory at this point, but we don't see much of anything happening on put call. And one way that I'm thinking about this, at least kind of experimenting with the idea of thinking about it this way is we know that we have seen over the last several months clear signs of professional money managers not really participating in the equities rally,
Right.
um, and they would be the source of puts in a crashing move, and so we may be seeing the type of downward move that doesn't really evidence a high put call reading, even if it is a panic, simply because the people who hold this market aren't as likely to use puts to hedge open equities exposure. Because we are seeing it in other indications, and I think that in the price structure to some extent, we're starting to see a pretty panicky looking tape. I've seen some banana peels on the bid. We've really just taken out a lot of levels. So it's tough for me to participate along these lines. If I really had conviction with what I'm saying right now, I'd be buying into some of this, and I'm not because it doesn't check all the boxes for me. I think I'd like to see some of the data that we get tonight, including the liquidity premium, maybe inverse ETF volume, to see if we're really getting to a situation where that's the case. But of course, we might see a sharp bounce into the close that precludes some of that. But
Well,
it's difficult to take advantage of. I could see this being a panic, even though it's not showing up in the put call.
well, the inverse ETF, I had a pretty big spike going on from I guess it was the August 2nd data.
Yeah, so I'd like to see that
So
after today.
yeah, so that was definitely.
It will be high. Yes, it will be very
Well,
high.
you've mentioned two now of the areas that have gotten into that severe pessimism range. Not to extreme measures. I guess in the VIX we could say is getting into that area. The VIX term structure, that is. Risk appetite index would be the third one, which was down about 50 pips from last week. This is the August 2nd reading. You got any thoughts on that risk appetite reading?
I don't look as closely at that one. I mean, we're taking in other data at that point, but that's reasonable to look at here because we can see some of it happening. I mean, that's going to take into account some of the stuff that we see in market dynamics right now. When you look at, look at the entire German curve is now in negative yield territory.
Did the 30-year go into negative?
Yeah.
Okay.
So when we're all just way underwater there. You can see some other features. Look at the yen behavior. You can see our bond market. So you see really obvious, gold is another one. You see really, really obvious, a really obvious sense that market dynamics are showing a super risk-off kind of environment.
Hey, Brett, I just want to note one thing while we're talking here, just in case we do start getting a bounce. But seeing a headline that Fed's Esther George, who of course was one of the dissenters from the rate cut, says she is monitoring market developments. This is coming from CNBC. I don't think that's really anything news there, but I suppose if people are looking for any sort of headline to buy into, Fed policy would be one of them. And coming from one of the dissenters, this is a headline that we're going to want to keep an eye out for any further comments. This lacks a lot of context. Of course,
it's not like we need her on board. If she
wasn't monitoring market developments, I'd be more concerned. But it is important considering that she is one of the dissenters. So we want to keep an eye out for any headlines from her for sure.
Yeah, I'd file that as of symbolic importance. If her and Rosengren get on board with the easing cycle, it removes resistance internally on the Fed, I suppose.
Yeah.
But the Fed funds futures have already been, showing us. We've got a growing bet coming on a double hike in next month. So, I think that the market is already, assuming that what we heard from Powell last week is no longer a relevant assessment of the future.
Yeah, and you talked a lot about that following the Fed, that they're going to kind of be levered to President Trump and his tariff agenda.
Yeah.
So
we have unification of policy. Yeah, trade policy and monetary policy are now working in lockstep, and that's not because the Fed has capitulated in a philosophical manner. It's just simply because they have acknowledged that trade uncertainty is now one of their primary inputs,
right.
And that is something that can be modified on a discretionary basis by the White House.
Yeah, particularly on business investment, which really for them is the only weak part. Certainly inflation running below 2% target was something that they could have pointed out, but they stayed away from that and just went and focused on the business inventory, like you were saying, or investment, I should say.
Right. There's channels in which it applies, and therefore it gives a de facto control over monetary policy to the White House.
Yeah. So we talked about some of the items that we watch regularly that have gone into the severe pessimism side of things. Still a number in the severe optimism, but I would note, Brett, a lot of the ones that I was looking at just seem to be kind of old. For instance, the bear market probability and mutual cash levels were both readings from June 28th. So, you're not going to get much from in there. But one thing that I did find interesting, this kind of speaks to what you're talking about a little bit, about why we're probably not seeing that put-call ratio, trying to tie that together. But the advisor and investor model, the AIM model, that remained in severe optimism, as well as the NAIM model, which
the NAIM,
the NAIM, which is firms who are active money managers who are asked each week to provide a number which represents their overall equity exposure at the market close on a specific day of the week. These were both August 2nd data points. So it really speaks to a lot of the selling that we talked about. We talked about how that robo ratio was running high, and that's not what you want to see from a breakout. And that certainly led to some of the shakeouts there. And, but again, kind of speaks to what you're talking about with that put-call ratio, perhaps not being as good of a read this time around, or at least not so much providing us panic on the big money side as it is some panic on the faster small money.
Yeah, I think that's reasonable to suggest that the faction of the market that is most responsible for really ramping up put exposure during an aggressive market decline is a longer-term, long-only, equity-only fund management model, and we have seen those flows, oddly enough, for most of this year go into the bond market, and that has possibly that may possibly be a factor that right now kind of contributes to a sense of the put-call ratio being a little bit less useful on an intraday basis during this decline. But this is all just speculation on my part. It may be me saying it's different this time when it's really not, and all we need to do is avoid buying until we see that spike to 150 or 160 in put-call, and then start to look for the long side opportunity, and maybe that's exactly what's going to happen. And that's actually, I'm operating according to that idea. I'm operating according to this speculative idea is actually untested and unreliable, and I'm still basically saying to myself, I want to see a spike in put buying before I start looking for buy the dip as a strategy in this particular sell-off. So I'm still operating according to that, but I'm just offering up the possibility that we may not see that. We may see that this is already a panic low coming into place, and you're just not going to get that put buying spike simply because the contingent of the market that would be responsible for that is not really involved in this market in the numbers that it would typically be after a large rally.
Right, and with that in mind, that option speculation data is still running in excessive optimistic territory there, and that's from August 2nd. So
Right.
really haven't seen that put buying coming in at all.
Right.
So, all right. So, I mean, that's pretty much what I'm seeing on the sentiment. A couple of other things that were of interest that I'd be curious to take your take on, and that's in the tech sector, Brett, where I know you cut your teeth a lot in the NASDAQ trading the NQs and stuff. So I'm really curious to see kind of your thoughts on the NQs. But one of the things that was sticking out to me was more than 44% of tech stocks have sold off hard enough to trade below their Bollinger Bands. And then the severity and the breadth of the drop has also pushed the McClellan oscillator for tech to a very low level. These are both generally signs of oversold conditions, especially in a rising market. So I'd be curious.
As of when?
These readings would have been as of Friday, I believe.
Okay.
This was a Monday report from Jason Geppert, in which he was quoting this. So with that in mind, I'd be curious as to your take right now on those comments. I don't know how close you follow Bollinger Bands at all or anything, but your take on that and the Qs in general.
I mean, just as a general statement, one of the indicators of more weakness to come usually in a market, and we talked a lot about this back in last November, is the idea that you trigger oversold technical indicators, things like oscillators and Bollinger Band readings that have a historical basis in saying, well, this is already technically oversold. When you do that and then you get sideways action and you gradually alleviate those readings before starting to tick lower, that's the sort of conditions that lead to the biggest type of downside move. So if we're seeing a situation where on Friday, before today's move, we already had oversold readings and the result is much more selling, that's not a good look for this market, and that sort of thing, violating traditional oversold readings by just simply piling on more downside, is the kind of thing that you see in a more bearish context. So, I mean, it's significant to me in that it's not the way that this should be behaving if we are somewhere in the process of some kind of upside blow off move. But this is one of the most difficult parts about this context is it's so dramatically headline driven. It's so dramatically news driven. It's so dramatically politically driven. If we saw this kind of behavior in a context where this wasn't immediately driven by changes in the rules of the game for companies and the market, it would be much more definitive. You could take much more away from a technical reading, but this is clearly being really pile-driven by deteriorating relationship between the United States and China, where it looks like Trump really rolled the dice, and China responded by, rolling the dice right back in his face. And it has the feeling of a continued escalation that's being moderated by China letting the Yuan slip and the White House having de facto control over the Fed, both of those things can allow this to persist indefinitely with deteriorating business investment. And the market's reacting to that. That's a shift in context, it's a shift in the rules, and it's a new sort of framework for evaluating things. And I, when that's the driver, it's not something that's just developing organically or what I call endogenously in the market. It's exogenous. I tend to kind of pull back on the assumptions that I'm making based on technical indicators. So I don't know what all of that adds up to, but I'm cautious about the market, and I'm unwilling to just barrel in and buy. But at the same time, it decreases the sense to which I apply a lot of value to technical dynamics, I guess, because so much of it is so clearly about recent developments in terms of the relationship between the United States and China.
See, I still think a decent amount of this too just comes from the Fed's misstep on the day ahead too. I think there was so much concern about Powell not looking prepared to be like a captain of a ship going into stormy seas, that also has extended this selling pressure down.
Wait, what's the cause? Sorry, clarify.
Well, the fact that Powell looked so uncertain.
Right.
Call
I think that's probably
selling. Like if there was the idea that that's okay, Trump's playing this game, but Powell's got this, I think that there would be a little bit more.
He looked like he was just lost at sea.
Yeah. And I think the dual thing, and that's why you remember we were talking last week, and I had said that I felt that there would be a little bit more selling, just because that Fed put wouldn't be. It's not that it wouldn't be as implicit as much as it wouldn't.
It's going to be there.
It's still as much. It's definitely going to be there. I completely agree. I just don't think that the Fed right now is instilling as much confidence as it has over the last 10 years.
I think it wasn't
a lot of that has to do with the fact that the president's just been hammering them nonstop for the past year too.
And that's definitely important. I mean, there's been a negative marketing campaign against the Fed from the biggest Twitter feed in the world, constantly, and that has to have some kind of impact. And if people don't have confidence in the Fed's ability to conduct monetary policy in a reasonable and rational way, that clearly is going to take a bite out of equity premiums. But I think that at the same time, the Fed being an enabler to a lengthened trade war is another issue entirely. Even if people had confidence in the Fed, if they knew that the Fed was using trade uncertainty as a primary tool to understand whether or not it needed to ease, and China's clearly doing the same thing, those tools are enabling the continued existence and the amplification of the trade war indefinitely, right? Because it hurts, but the pain, we've got an analgesic, we've got a painkiller that's always in there reducing the impact so that people don't really push back a whole lot against it, because there's easier monetary policy here, there's a weaker yuan there, so they can keep on feeding the fire and keep on escalating the situation indefinitely. And I think it allows this to be something that persists for much longer. And I think the market realizing that is also kind of, taking it on the chin when it comes to really trying to understand where, serious business investment and growth is going to come from.
Right. I did find it interesting. Did you see that the PBOC started up their own WeChat account?
No.
Yeah, so, expect the...
what does that mean? Yeah, go ahead. I think that's extraordinary.
Well, they just want to make sure that they can get their responses out quickly. It's all driven under the Politburo, right? So, what's the difference if they have an account or whoever has an account? But I just thought it was fascinating, and again, another reason why I remain long Twitter. I know WeChat's owned by Tencent, but I just found it fascinating. People are just flat out debating over Twitter, and social media now, in government circles too. So just fascinating to see that. Let's talk then, Brett, about the yuan. We're pointing out the 7 range yesterday and the importance of that. And what I think it did too was this week, it hasn't been announced the exact date. I believe it's going to be out Tuesday night. But for me, the easiest, most important data point in the globe this week is going to be the China FX reserves. And the one thing I'm not 100% sure of is what the time frame is going to be for what these reserves, what time period the reserves will cover. But here's the question for the markets, and one of the reasons why I think we saw such aggressive selling over in Asia and in Europe before we even broke into the U.S. once that crossed 7. In 2016, the last time this crossed 7, there was a concern that China had lost control of the yuan. Basically, it manages it against a band with the U.S. dollar. It buys and sells accordingly to keep it within that band. A couple years back, when it slipped through that band, there was general fear that China had lost control of this, and this was going to lead to a lot of capital outflow in the area, and a little collapse of that. Of course, China being so important in the global trade front, they're Germany's largest trading partner. When you get a weaker yuan, that's added pressure in Europe because all of a sudden they have trouble exporting out to China, and it also becomes trouble in the Asian area because they're trying to compete with China against a devaluating currency. You see President Trump railing about this all the time. The question for me, Brett, is this FX reserves for China. If they see, right now, I think the belief is that China's doing this on purpose to combat the 10% tariff raise. And we could get into yours and Carmine's discussion earlier. I talked a little bit about it with Carmine in terms of the devaluation to offset the tariffs. Right now, it's forecast that this reserve is going to be $3.11 trillion this time around. That's going to be down about $9 billion overall, a drop in the hat. But if we see these reserves come in a lot lower, suggesting that China is trying to combat this and they can't control it, then we could get that next leg lower, I think, of the global markets out of fear of what's going on in China.
Yeah, although I think we can see it in other ways. The last time that we had, you're talking about essentially a capital exodus from China to try to, and just to give people context, the point of that is the idea that at a certain point of deterioration, China would, in theory, be forced to radically devalue the currency, doing essentially a managed credit loss cycle and recapitalizing banks at a lower currency price, writing off a ton of debt. And that would be
what we saw on August 15th of 2015.
Yeah, well, certainly fears around that. We didn't see the intentional managed loss cycle, but we saw a radical devaluation. And if you imagine being somebody who's particularly wealthy in China, and they've got a whole lot of billionaires, you're sitting there with a certain amount of wealth, and it's held in a currency that could be cut by 20% in value overnight by the stroke of a pen in Beijing. And the idea is, how can you move this out so that it's no longer vulnerable to that? And it's one of the things that a lot of people believe fostered but it fostered a radical upleg in the commercial real estate market in the United States in 2016 and 2017, because that was one of the focal points, and in the UK,
Canada
where
as well.
A lot of money. What's that?
Canada as well.
Canada as well. A lot of money was coming out of China, and it was parking itself in U.S. commercial real estate in Canada and the UK and other places as a way to store value. Basically, like, that's their version of gold at this point. They could purchase commercial real estate properties from China, and that was one way to preserve their wealth in case of this sort of managed credit loss cycle in China. So if we're getting back to the mentality that we're concerned that the tariffs that the United States is applying on China China can't really manage its cycle well, and eventually we're going to have this sort of debt crisis arise, and the only defense against that is to do a lot of basically writing off bad debt, and that implies a major currency devaluation, that we would see this process of money trying to escape China. And the last time around, we saw them institute currency control
Capital
measures.
controls, yeah.
Yeah, right. So to
Which
prevent
we have not,
that,
which we have not seen, but that's one of the
we've
things.
not seen. So I'm guessing if we start to see that kind of thing,
You're right.
it would be maybe a more clear signal of that. At this point, I think that it's advantageous for them to allow it to fluctuate to the downside, particularly if they can shape the narrative where, you know, the long-term picture is actually better if they can manage to fight this out rather than to capitulate to a system that's going to infringe upon their longer-term growth in a poor trade deal. So I think that, you know, I don't know if that's happening yet, and I think that we would see it in capital controls probably first.
Yeah,
Or most clearly.
Well, I do think that people are going to be taking a quick look. If we're looking at key indicators, this FX reserves. Again, they haven't announced a specific a date yet for it, but for me, I think that the capital controls certainly. But I'm just talking about near-term indicators that we should get. Now, if we start seeing headlines about them restricting the amount that people are able to move into Hong Kong and stuff, then that's certainly going to start playing a role in it. But until we get that, this FX reserves, I think, is the only thing that people could go off of to see how well this is being managed.
And obviously, you're correct. If it was a radical change in that number, then we would start to have to speculate that's essentially an account that's being tapped for a defensive procedure.
Right. If we see this drop below $3 trillion for argument's sake, then that's going to raise a red flag and cause some significant overnight selling, in my opinion.
I think that's reasonable.
It could be, you know, that puke that we're looking for. I don't know. I just find this story to be fascinating on a lot of levels. The other, I suppose, would be, you know, there has been an argument because we really haven't seen any sort of inflation at all or anything like that from the first round of tariffs. One of the things that I think has helped embolden the Trump administration into putting in more. But the argument can be made, Brett, that you know, a lot of it's been offset by the devaluation of the yuan, and this is going back to, because if we take a look at this on a weekly, back in February of 2018, we were at about 630 against the dollar, right? So now we've gone up about 80 pips to 709. Which would be a devaluation of, what, about 14% or so?
Yeah, but we're also sideways for the last 2 years.
Yeah, no, and I'm not, well, not for the last 2 years. Yeah.
Well, roughly. Early 2017, late 2016.
Yeah, since that 2015 blip.
It's moved about sideways.
621 and popped to 659 on that day. Gone relatively
it's
sideways.
Not crazy what's happening right now. The currency's fluctuated back and forth. It's, you know, at the lower end of a range now.
Well, I guess my question would be, will the retailers see less of an impact potentially from that? Because, you know, there's a lot of talk about retailers taking the brunt of the latest round of tariffs. But with this decline, do you think it's possible that that's going to be overdone, opening up perhaps a buying opportunity in some of these retailers? Theoretically speaking, I'm not trying to put you in the spot.
I understand the dynamic.
How would you look at that dynamic?
I mean, the picture you're painting is that are the tariffs causing products that are coming from China to suddenly not have a price advantage on shelves, which means people pay up for something else, or the retailers absorb the cost difference themselves to try to maintain the same level of business, correct?
Correct.
Okay. So one of the factors that needs to be included in that is that even with a 10% increase in price, if there was no falling yuan, a lot of these products from China would still be the cheapest product on the shelf against comparable products. So there's some that really business doesn't change, and the retailer can leave it to the consumer to make the same consumer decision. It's just at a slightly higher price. I don't know if that's really something that retailers are going to be aggressively absorbing. Maybe it is. But Yeah, I guess, obviously to the degree that the currency falls, that's going to be a discount. So it directly offsets the tariff.
Yeah, yeah. I don't know. It's just one of the things I'm going to be looking forward to hearing. We're about a week away from really the thick of the retail earnings reporting season. They have that January end date, so they always come out later. So it's going to be some of the more interesting commentary that we have coming up over the next few weeks, and I really think it's going to help cement kind of where sentiment is on these tariff cuts.
Yeah,
Perhaps not cement, but
just a bigger picture point. I just think it's fascinating that we're watching this process where there's these other factors that are coming into play to more or less allow the trade war to blossom and to lengthen. I mean, it seems like with tying United States monetary policy in and tying in the management of the yuan, there's just a number of different factors that probably the White House didn't foresee in terms of the degree to which it could bring down the cudgel on China, and probably China didn't foresee, and economists didn't foresee, that allows this situation to just continue to deteriorate without it having a particular knife edge that's going to cause everybody to suddenly wake up and say we can't keep doing this anymore, or cause one side or the other to give in. There's just an evolution of the situation that allows everybody to acclimate to a greater and greater level of escalation, and I don't see where that ends. And I think more than anything, everything is going to react more to that dynamic than it is one particular data point about, even the retailers, even the retail investors are probably going to react more to the sense that this could go on theoretically forever.
right. Just quick headline and tell me your response, and I think I know what it'll be. Right now, if the Dow closed today, this is a zero hedge headline, it would be the third biggest point sell-off in history.
Who cares about point sell-off?
Exactly. I was just curious if you...
They want clickbait. Come on, give me clickbait. Zero hedge.
It's definitely a sensationalized headline, but I figured it'd be interesting just to throw that at you. Percentage is what we want, because obviously the Dow wasn't 26,000 17 years ago, right? So... Okay, let's do a little exercise here then, but we're about 30 minutes in, and I want to close out with this piece, and obviously we can circle around if there's anything. One of the key things that we wanted to do was provide a few indicators that we're going to be watching to see, when we've hit that panic area and when things could potentially turn around from this correction.
Sure.
Assuming it's a correction, of course, which I think is both of us how we both feel. Throw me out in order of importance your top 5 indicators, and then we could get into honorable mentions if you want. But I'm just saying, when you wake up in the morning, short-term indicators. When you wake up in the morning, I know you never sleep, so whenever you turn your head back to the computer away from the three twins, from the triplets, what's the first ticker, page, anything you're going to check?
Well, so all right, so.
And if you don't think that it's going to work out, because I know we didn't talk about this before, if you don't think it's going to work out like this,
I think we can do it.
We could do it. I think it would be helpful for giving people the rundown on what to look for.
All right, so I would say if we're talking about tomorrow morning, first thing I'm going to be looking at is bond futures, I think. That's the first market indication of a continued panic. Now, one thing I would note...
Now, you'd be looking at the ZB, I assume.
ZB and ZN together.
Okay, so what would you recommend a user who doesn't have access to that, the TLT?
Yeah, I guess so, right. I mean, but you can go on to lots of different sites online and find real-time data on yields. CNBC, actually the CNBC.com website, if you go through the market section, has a spectacular bond yield real-time service. Like, you can see everything from around the world all the way up and down the curve, every single major market in real time. It's great. If you want to see what the Japanese 10-year is doing right this second in terms of yields, CNBC is a great resource for free data, free real-time data on bond yields around the world. So you can check that out, or, if you've got futures data, you can check the ZN or ZB. But I would point out, something we didn't talk about is that large spec money is still net short the bond futures. So I think that's a spectacularly interesting fact. If you look at CFTC data for bond futures right now, they've been short since the lows. They've been short since we had the deep pullback in bonds that was really in the best of times, kind of capitulating itself to the upside back in last September and November. We've seen net short bond futures the whole way up. We've never seen the big covering. So this could go much further in bonds based on that piece of information. We could go all the way back to new highs, the type of levels we saw back in 2016 around Brexit, just based on how people are positioned. This could be the beginning of a big extended squeeze continuing in bond futures. So that's important to note, and that can escalate. We've got liquidity issues in the bond market because of what the Fed has done, soaking up so much supply. And the bond futures tend to signal things to equities. One of the best shorts that we had on this service from Chart Trader was shorting based on a spike in bond futures. I can't remember when that trade was, but it was very clearly, I put it on based on what we were seeing. There was a sudden spike in bond futures. Equity market was holding up. When people started to process what was happening in bond markets, you just saw equities start to sell like crazy. Like, there is definitely a psychological relationship there. So that could escalate things further. That's probably the first thing that I would look at. I would check out the yen. Basically the same logic. Yen futures right now are pretty much neutral. We don't have a ton of money levered long the yen. And as far as sentiment data, strict sentiment data, we talked about the VIX, the term structure in the VIX futures market. That's important to understand. Basically, the idea there is if you see an amplification of VIX readings right at the front of the curve at the spot market, but you see it not so much the case out the curve. You get what's called a backwardated VIX term structure. That's usually something that reverses itself. Very, very little of the time does the market sit in a state where there's greater uncertainty about the immediate future than there is about the longer-term future. Just a simple philosophical point. And oftentimes, in big important bottoms, in panics, that bottom is preceded immediately by a big spike in the VIX term structure, where you see a panic about immediate sense of volatility, but you see less concern about volatility and uncertainty further out the curve. So I would want to be looking at that. The other one is the SPY liquidity premium. We talked about this a few weeks ago. Basic idea there is if people are only trading big index instruments and they're afraid to trade individual stocks, you see that show up in how liquid the indexes are versus the individual stocks. That's one of the sentiment data points that I monitor closely. When you see a situation where everybody's afraid to trade the individual stocks, it shows you're in a panic. It shows people are afraid of a further crash because they feel like if they were in some mid-cap stock, rather than, let's say, in the SPY, that if we started to get that next level headline, they'd be trapped. The market would go off a cliff, we'd see 1987 all over again, and they'd have no ability to sell because the bid is a mile below the market. So the illiquidity fear is the sort of last stage of a real panic, when people become visibly scared of trading individual equities, and instead they only trade things like the big index ETFs and the futures because they're afraid of the inability to get out. That shows a complete lack of confidence in the underlying structure of the market to function at all, and that's usually something that can't persist very long without a bottom coming into place. So that would be another big key. Beyond that, inverse ETF volume would be another one I'd want to look at, particularly tonight, tomorrow morning, to see where we got to, because you can look at historical norms. If you have just an insane amount of assets flowing into inverse ETFs, it kind of works a little bit like the put-call ratio, and I'm curious to see if we don't have a lot of professional money managers highly exposed to the stock market, so we don't see it show up in put-call, we might see it show up in inverse ETF volume, and that would effectively, in this case, be speculation on further downside, people crowding in short this market using highly liquid vehicles like inverse ETFs, so people buying.
Yeah, that was probably the most aggressive move that I've seen out of any of those readings that we had in terms of a spike, just people piling into that.
Today it should be much bigger. So we'll get that data later, and that would be another one that would really show that people are just really piling in to bets against the market. And when there's a consensus there, you've got a bottom as well.
All right. Any other honorable mentions here then?
No, I mean the short-term data points. I think that pretty much covers it. You've got the market indications in terms of the bonds and the yen. You've got these particular close-up measures. I mean, obviously put call as well. I don't think I even
Right.
included that. So clearly, if we see a put call strong spike, I want to see it. I like to see it above 135 or 140 to call it a panic. We're just sitting around 119 right now. And not really showing that kind of crazy action. Early this morning, we saw it up as high as 140, in fact, above that a bit for a very short time. But as I've said, it's important to place less emphasis on the early morning put call data because it's not a cumulative data point. The first reading of the day, if one person buys one put and one person buys one call, then that's it. It's a ratio of 1 to 1. That's your ratio for put call because it just really builds from the ground up. You need to get some big data in there. You need to get some big numbers in there, and it needs to kind of build a personality, and that takes maybe 35, 40 minutes into the day before you start to see data you can rely on with put call. And once we got to that point in the day, we fell down below 130. We saw some call buying, brought us all the way down under 1.0, and we've started to steadily climb from there. But we do by no means do we see something that looks like a panic in the put call data, even if we do see it a little bit in the fixed term structure.
All right. So, Brett, to bring this all back, we gave the what we need to keep an eye out on. But I mean, overall, what we're looking at here, it feels like, is obviously no buyers have come in yet. Looking for that price discovery on. It feels like we're looking for price discovery on a long-term trade war, which had not been priced into the markets, and. I don't think either one of us are hitting the panic sell button yet. Are you getting more aggressive to the short side? Are you more interested in buying pops or fading pops?
This is what's called a range expansion day to me. So what I would advise people to do, where you see a dramatic expansion in range, if you go back to before today, it's been a long time since we've seen a range this wide. Certainly, back in May, we saw a couple days a little bit like this. And then you'd have to go back to January and December. This is a different level of scale, of magnitude in terms of the sort of range. And oftentimes what I find is this is the type of day where people can lose the most money if they haven't learned this lesson before. So I want to just speak to the lesson. And it's because you have a reversion to the mean instinct where when you start getting an outsized move, you start thinking, well, there's no way the market can go down further when it's down 2.5% because you've become kind of acclimated to an environment over the preceding several months where that was the biggest sort of move you could ever see. And so people tend to buy and buy and buy, and then it goes down another 1.5%, gets down 4%, and suddenly you're like, oh, this is an awful day because you hadn't really stood back and allowed the range expansion to happen, allowed yourself to be transported sort of through the market's wormhole to a different universe where the rules are a little bit different in terms of your intraday assumptions. And it's good on a range expansion day, once you get the sense that that's what's happening, to be very selective, let it build out, and then to trade much more aggressively in the following 2 to 5 days. Once the range expansion happens, then you start to get a market that's loosened up a bit. The algorithms are, beating off the inside market a little bit. Things aren't controlled as much. People start to chase moves back and forth, and it becomes much easier to trade even really small time frame scalps in something like the futures. But to do it on the first big day of range expansion is dangerous because you're sitting there with a lot of assumptions that really kind of come from a subconscious need for reversion to the mean. And it's good to allow the new wider range environment to establish itself, to not really burn yourself in the process, and then to take advantage in picking up the pieces. And I don't know for me whether that's going to be long or short, but it's probably going to increase my activity for this week, throughout the week.
All right, just a quick heads up. We're about 15 points off the lows now. This has just been going on over the last couple minutes. Not seeing anything headline related at all. This just looks like an attempt for some buyers to pop in. Just looking at 28.25 here on the S&P. For the Nasdaq. We're seeing some buying coming, I guess, right around the 7,400 area. But again, not really seeing anything behind this at all, like outside of an attempt to buy a bounce or to find a bounce in the indices with the final hour trade. All right, Brett. Anything we're missing here?
So one last point I'll make is you've got two puts now because you've got a unification of policy. So there's the White House put and there's the Fed put. And I think that since we've seen the structure we've seen come into place, the White House put's probably going to be more important. I don't know how far down it is though, and the strike price may be so far off that it only becomes a factor if we crash, several times what we've seen so far. But there is a possibility that the White House shifts its focus on headlines based on how volatile the markets become. And you've really got to watch for that being the number one kind of sort of headline driver that could really burn you if you're sitting short.
All right, so there you have it. So, Brett, we'll continue to monitor this action going on. Like you said, there's a chance you could be pretty active this week, so we'll be keeping a close eye on that. And, we'll be keeping a close eye on the overall action here, looking for opportunities.
Got it.
All right, Brett, you take care of yourself. I'll talk to you soon.
Okay, Gav.